Hi everyone. The last few months truly have been a roller coaster ride, and the reasons have been plentiful. There is a set of fundamental factors, and then the consequent technical factors seem to have mixed up to produce a really volatile cocktail, which is what markets have been over last several months. Uh, let me put it this way that before I comment on each of these factors, that after all the ups and downs and the violence that we've witnessed, actually the picture in terms of buying and owning quality businesses has become actually very favorable for a simple reason that the fundamentals and the merits of the quality businesses have remained intact, if not become more solid. And on the other end, the prices have corrected across the board, and therefore, the price value equation or the margin of safety equation has become very, very attractive. Let me talk about the fundamental factors first, and there are three mainly. Oil price has been an important one. The trade volatility in the world in terms of the changes, a second important factor. And I would say, thirdly, the concern also has been on what happened to the non-banking finance firms based on the default in the CP markets in the month of September. Now, if I have to really deal with all the three, I would say of these three fundamental factors, I'm a bit more concerned about oil price, and the rest of the factors I think are either on the mend or probably are actually favorable. And let me talk about each one of them. Oil price is an issue. Every dollar of an increase in oil price represents about $1.5 billion of roughly an outflow for the country per annum. Every $10 increase in oil price would mean about 12 to 15 basis points increase in inflation, and every $10 increase in the oil price would imply 15 to 20 basis point of the reduction of the GDP growth rate. So oil is important. I hope the worry on the oil, if the prices do jump, as people speculate, to more like $100 and above, that it's more of an acute sharp pain for a short period of time rather than a prolonged chronic pain, maybe at levels of $90 and thereabouts of oil for a long time. The second scenario would be more difficult. I have no clue to be able to predict whether oil will go to 100 as some are speculating, or oil will go to 60, 65 as some other bunch of people are speculating. Be it as it may, we have to be prepared in terms of the econometrics effect of what oil price entails, and importantly how it reflects into the profit and loss account of some of the firms where raw materials are oil based derivatives, and to that extent some oil inflationary impact we have seen in the businesses like paints and the adhesives and others, where there has been a cost push kind of an inflation. Net net, it's a situation we need to watch. Oil prices have corrected in last couple of weeks, thankfully, but we cannot really be sanguine as to where it is going to lie, and we have to wait and watch. So this is an area that definitely remains an area of concern to my mind. As far as the trade conflict is concerned, probably the intended beneficiary is China, and it is early to say where it is going to get headed to. But I believe India is unlikely to be a loser. Probably out of all these, India might be a gainer, but more on that will be known only over a period of time. Probably after the midterm elections in America are over, we'll get a more clearer picture as to how things are shaping on that front. Third, what happened in the CP markets where a default occurred by ILFS, and consequently it created a shock chain reaction through the system and gravitated into the equity markets. Concerns for the people have been that firms may get dried of liquidity, the cost of capital might increase for the firms at margin, and the leveraging may get tighter, and therefore the firms may be unable to register as much growth as they witnessed in the past. I would say, and of course, there are fears that there is an asset liability mismatch. I would say, in all of these concerns, really the quality firms, disciplined NBFCs, the ones which have been very prudent and wise about how they are conducting their business, would actually be big gainers. And when the public sector banks met with trouble on their balance sheets on NP account, the benefit went to the private banks. When some of the private banks were impacted by bad loan issue, the other private banks actually gained, which had solid balance sheet and low NPAs as an issue. And I equally believe when this trouble on the NBFC front has come, the advantage will go in favor of disciplined quality NBFCs at the expense of the other ones. And therefore, while it has caused disturbance in the market and it has clearly created worry, as far as we are concerned, we believe quality firms will, in fact, when the dust settles, will be a big gainers. And we are already seeing some evidence in terms of the behavior of the prices of many of the quality firms as to how that is shaping up. Then the host of technical factors got mixed up. Many loan against security accounts got imploded by the NBFC firms, and therefore it resulted in aberrant kind of sales in the marketplace. Margin money calls occurred. Foreigners have been selling in any case for a long period of time, partly for their interest rate rise issue in America, other part being the rupee depreciation. But all of that kind of added fuel to the fire, where fundamental factors got kind of mixed up with a lot of technical factors. And then clearly fence sitters who were holding out felt that their profits will disappear, and they began to sell. And at the fag end, typically it is the quality which will sell and not the others. And because quality is the only space where you still would have profits, and therefore from third week of August till about October end, what we have witnessed is actually the quality basket and the quality stocks have fallen more. And that's where I believe great opportunity is lying. All indications are that the firms, the quality firms, the strong ones are benefiting immensely. Some of the systemic big reforms that have occurred, demonetization, GST, Real Estate Regulation Act, very importantly Insolvency and Bankruptcy Act led bad loan resolutions, not to forget closing down of the shell companies and repairing and reforming the bad loan mess on the bank balance sheets. All these important big changes are beginning to kind of settle down, and therefore solid, qualitatively sound and compliant firms are actually on a strong wicket. We witness in the first quarter of the current year, for the June 18, our portfolios on an average witness 27 odd percent top line growth and close to 37 to 40% growth in the at the bottom line level. And all that we see around in the environment, whether consumption of consumables, consumption of durables, barring car where we witness some softness in a couple of months, the two-wheelers, commercial vehicles, even tractors, all of them have been doing well. We have also seen in terms of the hotel occupancy, in terms of the air traffic, and many other indicators seem to suggest, not to forget the credit offtake, which is now touching close to 14%, that actually economy is on a good footing. Barring oil, I would say rest of the fundamentals remain intact, and even a rupee depreciation is really in price adjustment to the external reality, and therefore I do not believe that there is anything amiss about rupee depreciation, partly caused by trade conflict and the other part due to the oil price rise. So net net for the quality businesses, prices have come down, fundamentals remain rock solid, and actually the picture from a margin of safety perspective in quality basket has become very attractive. And I would say every such seeming threat is an opportunity, and I believe we are staring at a wonderful opportunity today.